Hello friends, today we are discussing if the rate of interest is further going down on July the 30th. And thanks again for making all our videos super successful. Thank you very much from the bottom of my heart. Now before we move further, you all know friends that the moment we reach 2000 subscribers, your name will go in for a draw if you are subscribed, and one winner gets a $250 Costco gift card. Also, when we reach 10,000 subscribers, we have another draw, and again if you are subscribed, one winner gets $2,000 cash, which could go towards your mortgage payment or rental payment. Now both these promotions are published on our website. Just by subscribing, you get your name in for the draw. And friends, since you're watching my videos in thousands and thousands, just hitting the subscribe button may make you win. The names of the winners will be declared on this channel, and wishing you all the best for the same. Coming back to today's topic, is the Bank of Canada reducing the rate of interest on July 30 or not? Now, we all know that the Bank of Canada is set to announce its next interest rate decision on July 30th. The central bank's decision will be heavily influenced by recent economic data, particularly inflation figures. Now, as Canadians eagerly await the July 30th Bank of Canada rate announcement, Canadians are hoping for some relief from the high interest rates that have burdened households and businesses for over 2 years. Yet, despite growing economic fatigue, the Bank of Canada has opted to keep its key policy rate unchanged for the last 2 times. Now, this decision, while disappointing to many, is rooted in a complex combination of inflation dynamics, global instability, and cautious policy making. Now, at the heart of Bank of Canada's decision is one key issue. Inflation remains stubbornly a little above the Bank of Canada's target rate. While inflation has moderated from its 2022-2023 highs, it has shown signs of stickiness in the services sector and food categories. Rent, insurance premiums, and other non-discretionary expenses continue to rise, leaving policymakers concerned about underlying inflationary pressures. Now, the central bank cannot justify easing monetary policy when core inflation, which excludes volatile items, continues to hover over the target range. The Bank of Canada has repeatedly stated that a premature rate cut could reignite inflation, undoing the purposes made through aggressive rate hikes since 2022. The economic data released in June and July, including consumer price index and wage growth reports, showed mixed signals. While manufacturing and housing slowed, consumer spending remained resilient, bolstered by strong wage growth and still tight labor markets. Another inflationary risk the bank cannot ignore. Now, despite the economic cooling, Canada's labor market remains tighter than expected, with unemployment rates staying below 6% nationally. Now, employers continue to struggle with labor shortages in sectors like healthcare, construction, and technology. Wage growth, while easing slightly, is still at a rate that could sustain inflation over time. Now, for the Bank of Canada, this is a red flag. The central bank sees elevated wage growth without matching productivity gains as inflationary. Until the labor market shows more definitive signs of softening, especially in full-time employment and wage increases, the bank is unlikely to move towards a rate cut. Now, then there is global economic uncertainty. The decision is also influenced by global macroeconomic risks, geopolitical instability in the Eastern Europe and in the Middle East, ongoing disruptions in global trade routes, and persistent supply chain vulnerabilities have created a fragile environment. Now, central banks worldwide, including the US Federal Reserve and the Central European Bank, have largely held off on major cuts this summer, fearing a resurgence of inflation. The Bank of Canada, while operating independently, takes these signals very seriously. Now, in addition, the Canadian dollar remains sensitive to US monetary policy. If the Bank of Canada were to cut rates too early while the Fed holds steady for hikes, it could weaken the loonie, increasing import costs and putting further upward pressure on inflation, particularly for energy and food products. Then there are housing market concerns. Although the housing sector has taken a hit from high borrowing costs, with falling home sales and new construction slowing dramatically, the Bank of Canada remains cautious. A rate cut could trigger a speculative rebound in real estate, especially in hot markets like Toronto and Vancouver. So policymakers are wary of reigniting housing bubbles and undermining efforts to bring housing affordability under control in the long run. Moreover, the rental market is under stress due to immigration-driven population growth and limited supply. Now, lower interest rates could exacerbate this by pushing investors back into the housing market before enough supply is created to meet demand. Now, this would defeat the long-term structural goals set by policymakers at both federal and provincial levels. Now, perhaps most importantly, the Bank of Canada is acutely aware of the importance of maintaining public and market confidence. After being accused of misjudging inflation in 2021 and falling behind the curve, the Bank of Canada now errs on the side of caution. It wants to avoid creating a perception that it is caving down to political pressure or short-term economic discomfort. So, by holding rates, the bank is sending a clear signal. It will not declare victory until inflation is firmly under control. It wants to ensure a soft landing, not a rebound or into inflation or market instability. So in conclusion, while many Canadians are hoping for a rate relief in July 2025, the economic fundamentals, inflation, wage control, global instability, and housing risks do not align to support such a move. The Bank of Canada's decision reflects a commitment to long-term price stability over short-term political or public pressure. Now, patience remains the name of the game. So in conclusion, I can say that the Bank of Canada is highly unlikely to ease monetary policy this month end. For now, Canadians must brace for continued higher borrowing costs while policymakers wait for clearer, more consistent signs that the economy is ready for a rate cut without risking a rebound in inflation. So friends, should you have any questions on the same, please feel free to call back as you always do. I will answer your questions and we take it from there. And thanks again for watching this video in full. Be blessed, stay safe, and see you in the next video with another topic very soon. Thank you.